Welcome back to the Money and Wealth Show. I'm Sterling Fox in conversation with David Smith. Mr. Smith is a resource sector analyst. And David, just before we took the break, we mentioned junior mining companies. We're talking about country risk, but there are three levels of companies in the mining business: juniors and seniors and those in the middle. When an investor, a potential investor, looks to put his or her money into a commodities outfit, what method should be employed, perhaps, by way of distinguishing whether a junior company would be most appropriate, or a senior, more experienced company, or something in the middle? How do individuals go about finding where they belong in terms of investment comfort?
Well, I think one of the ways is by doing due diligence on the different companies that you might be interested in. Go to their websites, go to conferences and talk to people that are involved in the companies, and then ask yourself, what do I expect in terms of profitability and the acceptance of risk reward in this regard? And so the bigger established companies maybe have less risk, but they also maybe have less potential appreciation.
Sure, yeah.
So,
and it's a higher buy-in too, isn't it?
Yes, right, yeah. So you might have to pay $40 for a stock in a major producer, and the odds that that's going to go to 160 are probably less than a junior that maybe is really up and coming and has increasing production every year that's priced at $1.50 that might go to $10. So on a percentage basis, even though you're accepting a bit more risk, you do have an established producer, and if things go well, you could actually make more money with the junior.
There's a lot of, for lack of a better word, propaganda out there on the part of mining companies and resource sector companies, period, because they all want you and I to fork over our investment dollars in their operation. How does one go about sifting through all of the blizzard of information or alleged information and get down to the nuts and bolts of what really matters in assessing where to move forward?
Well, I think you could actually come up with a kind of a sheet of checkoff items, which I've never done this formally, but I think it would work real well, such as what are the number of shares outstanding and fully diluted, because you have companies that are always raising money that haven't made much profitability, and over time you have the market flooded with their shares, so it takes a lot more money to move that stock. And then you look at what have they done in the last couple, 3 years, what have they done in relationship to what they said they do. And so you're looking at that, and are they increasing their production if they're a producer? What's their cost per ounce? Are they quoting you gold and silver equivalent ounces, which has a very heavy base metal credit to it, and not that much gold and silver? Or is it more of a pure silver operation? So looking at that mix of what they produce, and what do? Do they produce doré bars on site, or do they send concentrate out someplace to have it produced? Do they have credits that taken out because they have a lot of impurities in their metal? So there's a number of things like that to look at. And then of course you can also use technical analysis to look at the charts and see, where has that stock been? That's important.
In tighter economic times, like the one we're living in right now, do people tend to do better homework? Is that your experience?
Well, it's hard to say. The thing is, it depends on what the market is doing. If we have tight economic times, but there's a strong up leg in the resource sector, a lot of people are drawn in to just go with what's hot that day or what seems to be moving. Right. And they go just the opposite of what they should do. When prices are weak, if they know they've got a good company, they should be buying some or buying more, and then when it goes up, they should sell some of it. But they have a tendency to wait and think it'll go lower and lower, and when it turns around, then they wait quite a while, and then it's up there, maybe it's doubled in price, and then they buy some right at an intermediate peak, and then they go through that destructive cycle each time.
There is a human tendency to become emotionally involved with your investment. Even though it's just business and it's just money, you know, this is my mining company. This is the one this is going to be the one that's going to take me to the promised land. And instead of selling it when we should, when it's sensible, when there's a reasonable profit to be taken, we tend to cling to these things too long. Is that another of your experiences?
That's exactly true. And you know, you look at the last, the big mania, the dot-com mania that ended in 2000. I know people that bought a stock at 50, rode it to 250, and sold it at $15. I mean, they did the whole round turn. And I use an example of a stock, I won't mention the name of the company, but I could give you dozens of examples like this. This one particular stock in 1999, it was a resource sector stock here in Canada, sold for 9 cents a share, went to $21.90, and I think it was 2006 or 7, dropped to 35 cents in 2008 when we had this collapse across the board of the financial sector, and now trades around $6. So that's quite a ride.
Incredible stuff. Our guest is David Smith. Lots more to come. Stay with us here on The Money and Wealth Show.
Good afternoon. My name is Larry Ray. I'm the president and CEO of Gold Ray Resources Corp., a company that trades on the TSX Venture Exchange and has the majority of its operations in China. We are currently developing a resource there with limited production at this time. Our goal is to increase this production up to about 1,200 to 1,500 tons per day. And to do that, we are negotiating with several Chinese companies, one of which will become our partner either directly into the company or into the project, which will allow us to move the project up to the desired tonnage. For further information, please visit our website at goldray.com or phone 604-531-9639.